So it's pretty crazy how bad the rental market has gotten, and as a result, and how expensive it's gotten. And so, people that are renting are in a bind, right? They are looking at extremely expensive rents for apartments that they don't really want, and rates are up a little bit.
Right. And I think people also like at this point, like obviously stock market's not doing great. So I think people are like, you know what, the safest bet has always been real estate and always be real estate. So I think a lot of people that are renting are like, you know what, why would I keep renting when I can buy and pretty much almost have the same monthly payment? And it's a future investment as well. So
Totally. Okay, so why don't we kick it off and take a look at our first slide?
there we go.
Okay.
Well, one thing I wanted to address, Mark, was the fact that I think that there's a misconception of, I think people, when comparing the rent to buy and the numbers, people for some reason think they have to put down 20%. So if we go to the next slide, Charles, and you'll see in the middle slide, I used a purchase price of $700,000, for example. So everyone thinks I had to put down 20% and so forth. So if you look at that number of 700,000, the monthly payment, just to add it up real quick, comes out to about $44.59. So using those numbers, Mark, I think people will see that, well, currently I live in maybe like a 1-bedroom in a certain location, and they're about to raise my rent to like $5,000 a month. Why wouldn't I, buy and have the same, if not in some cases, less of a mortgage payment?
Yeah, let's talk about that 90% mortgage for a second. So, in what cases can you get a 90% mortgage?
So typically, condos, one families in the city, if we're talking about co-ops, it is allowed, but it depends on the board. So there are certain co-ops that will allow even 5% down. So it's something that when you're working with your realtor broker that you may want to ask, hey, do they allow 5-10% down in the building? But at Citizens Bank, we allow 5-10%, no problem. There will be a little bit of PMI, for example, we put that in the monthly payment. But traditionally and statistically, it's going to be a condo or a single family.
Got it. Let's talk about condos for a second. Condos are actually co-ops, but they kind of have condo rules, right?
Right, they follow the same rules. So in that situation, you'll be able to put down 10%, 15%, and not get it, but there's different structures. So, again, you don't have to put down 20%. When I'm talking to customers, I always focus on the monthly payment, right? I mean, obviously, if you can see in these scenarios, whether you're looking at the 1.2 price, $700,000 price, the rates are still in the 4s. Now, maybe like 2 months ago, they were a little bit higher, but people don't understand that the interest rates have come down a little bit. So, which is very interesting. So it gives people more buying power, if you will, where, for a while, the rates were maybe in the mid-5s to high 5s. So even to do like 10-50% down, you still have a good monthly payment that you're comfortable with.
Yeah, and let's talk about, like, people seem to think that there's one rate, like the mortgage rate is X, right. and they're hearing stuff like the mortgage rate is near 6% or it's north of north of 5.5%.
Yeah.
But that's not true for a lot of lenders. I mean, sorry, a lot of borrowers, right?
Right. So like I know for different loan amounts, right? So we're going to bring up a slide that has the loan amounts for single families in New York. So for a single family, if we look where it says baseline national conforming loan limits, thank you, Charles. So on the right, go to the far right, because last year in 2021, it was 548,000. But every year, Fannie Mae will do a look back and see, the growth and the incline, the rise of home value. So they'll start to raise the loan limits. So for example, today, if you're going to buy something and you're going to borrow $647,200 or less, that means it's going to be a Fannie Mae loan. Okay, so that means your rate is going to be somewhere around 4.875 to 5%. That's a Fannie Mae loan.
Now, so right now, 4.875 to 5% on a Fannie Mae 30-year fix, right?
Correct, with no points.
Okay. And what is this loan limits in high cost areas? What does that mean?
So that's like a different bucket of what they call high balance. So from 647,000 to 970,000, it's like a separate Fannie Mae bucket. So for example, if you have like, let's say top tier credit, and if you're going to a bigger lender, you're going to go straight to a jumbo loan. So The 647 to 970,000 just gives Fannie Mae more capture rate, but to some customers maybe don't fit the box of a jumbo loan, if you will. Because jumbo loans, you have to remember, which is typically anything above 647,200. Every big bank, when they're doing a jumbo loan, they're holding onto it. So, Citizen Bank takes in a loan for 7, 8, 900,000. We're not selling. So we're going to be a little bit more, maybe sometimes stricter with the FICO score, with the reserves and the ratios. Where if you're going to borrow in a high balance Fannie Mae, there's maybe more flexibility sometimes, if you will.
But there's different rates for jumbos, right?
Correct. Yes. So today, if you're doing a jumbo loan with no points on a 30-year, we're at 4.5%, which has been even historically. I mean, like a year ago, they were maybe a little bit lower, but still, I think maybe like 2 months ago, they were closer to 5%, and they've actually come down in the last month or so.
So let me just add this point. Most of the people that borrow in this town are borrowing jumbo.
Correct.
Right? We're not really a conforming loan market. Like
Correct.
For Manhattan loans, what percentage of your loans are conforming?
Not many. Not for the most.
Right.
Maybe like 20%. Maybe.
So mostly jumbo, right?
Yes, mostly jumbo. Yes.
And the jumbo rates are below the conforming rates, right?
Yes.
So the big loans are cheaper.
Yes, right now.
So when people are hearing the rate is 5.5, that's not actually the rate they're borrowing. They're borrowing at a much better rate in this town, correct?
Yes. Unfortunately, the media sometimes hypes it up and scares customers away. But they need to know it's very important that the rates have actually come down. And to your point, they're below 5% right
now. And how big of a loan can people get?
Listen, 4, 5, 6 million. I mean, it depends. I mean, so when you're a portfolio lender like Citizens, we have our own portfolio. So if you're coming to me and you're buying something today, let's just say for 3 million, you can put down 20%. We also offer relationship pricing. So customers don't understand, which a lot, even first-time home buyers, they're going to move over 200,000 Citizens to get an 8th off. They move over 500, they get 3/8 off the rate. So on a 30-year jumbo, if we're quoting 4.5 and you're moving over assets, potentially you could get down to like 4%, 3.875 on a 30-year, and that money's yours. After closing, you can exit, you can take it out. There's no restrictions. They're not going to change the rate on you.
So I think this is super important because I think a lot of the things that have been scaring people from the sales market when they've been renters traditionally, and let's get real, New York City is a city of renters. Like
yes.
70% of the people that live here rent.
Yes.
So this is like no shame. I myself am renting right now. Okay. So I'm not disparaging renters. I'm just saying that a lot of times they don't understand that the rates are actually excellent right now. And if you have that option with putting some money with Citizens, I mean, that rate gets right down to 4%. I mean, that's bananas.
Yeah.
Yeah. All right. So let's take a look at a rent versus buy calculator that is on the New York Times. I'm going to share my screen, and I just want to show you guys some analysis, which is why a lot of people are on this stream. And we got a lot of people on the stream right now, so I really appreciate that. Okay. So this calculator, if you just go to New York Times, you can sign up for a free account and get to this if you don't have a paid account. But just Google New York Times rent versus buy calculator. You'll find this in about 2 seconds. I pre-populated this calculator with some inputs. I just want to walk you through what I did here. So I took a home, which was 1.495 million, and we'll look at that home in a minute. And I said, we're planning to stay here for 10 years. Now, why did I pick that, Johnny?
For 10 years, just for the flexibility of, you'd be surprised in my pipeline. Like I have a lot of people, traditional 30-year fixed, but then a lot of people, we have a product where you could do a 7-year interest only or a 10-year interest only. Why would I do? Yeah.
So most people don't stay in their homes 10 years, right?
Statistically, like nowadays, we're just in a different generation, right? Millennials and Z. So people are on the go, who refinances, who wants to cash out, who wants to go home equity line of credit, divorce, unfortunately, life happens. So statistically, people will do something in 7, 8 years. So I never push, I just give them the options. But a 10-year ARM interest only is also, the rate's also cheaper. and also gives you more flexibility in the monthly payment. It's about $2,000 less a month and more cash flow, which people like.
Interesting. We'll talk about that more in a little bit. Okay, so in this calculator, I put in 10 years. You can play around with it as you want. The mortgage details, the jumbo is at 4.5% right now, right?
Correct.
Okay, so I put in 4.5% for the mortgage, 20% down, just being conservative about that, and 30-year mortgage. Now they have a bunch of inputs which are like hard to come by. So I just want to tell you guys, I actually went and calculated these numbers for the last 30 years in New York City. So this is not Case-Shiller, U.S. based averages. This is New York City prices. Home price growth in the last 30 years has been 5.5% in Manhattan. Rent growth rate has been 6.3%. The investment return rate, I just did S&P 500, and I looked at what it was 30 years ago, and calculated the compound annual growth rate at 7.7%, inflation at 2.5%. I put in the actual property tax rate that the property in question has, and a marginal tax rate of 30%. You might be higher, you might be lower, but that's about right for your average buyer in this price point. I put in closing costs. Closing costs are a tricky business in this town just because the calculator, there's many different step functions in many different parts of the calculation, and there's many parts of the calculation. So, but for buying a condo and selling a condo, these numbers are pretty good for my estimations.
So co-ops obviously a lot less. But.
Co-ops are a lot less. Yep. But in this case, I'm looking at a condo as an example, so we're going with that. The rest of these numbers don't matter that much because they don't impact the price, the outcome. So let's just look at the punchline here. It says, okay, so if you're buying a home for $1.495 million and it has those characteristics with that maintenance and that, those common charges and those real estate taxes, that if you can rent something that's similar for less than $4,300 a month, then you should rent. Okay, let's stop sharing now for a second, Charles. So I took the liberty of pulling out an actual example. So this one is in Zeckendorf Tower. I am not, the reason I chose this apartment is not because I particularly like this apartment, although I don't dislike it. I chose it because it's in a big building and there's another apartment for rent that's very, very similar, almost cut and paste of this apartment. So you'll notice this one is on the 20th floor, 1 bedroom, 1 bath, 740 square feet. And go back to the sale one for a second. This one is 785 square feet, 1 bedroom, 1 bath on the 18th floor. So these guys are like about as close comps as you guys can get. And so this one is 1.495, and the similar apartment, it's very, very similar, you guys, and finishes and everything else, views, everything, same building, rents for $5,000. Now the New York Times calculator, after carefully putting in all those inputs, which I hopefully have saved you from having to do, says, okay, well, if you can rent this apartment for $4,321 or cheaper, then you should go ahead and rent. But it's not the case. This apartment is $5,000 apartment. So just on a pure, like, apples to apples, is this a better thing to do with your money? Yes or no? It's better to buy this apartment. But is it as cheap on a cash basis to do that? Let's take a look at that next. So, Johnny, how much would it cost to finance this thing with a 30-year fixed jumbo?
If you're doing typical 20% down, you're looking at all in, Mark, would be about $8,400 all in on a 30-year fixed.
So $8,400, right?
Right.
And so So that begs the question, doesn't it? Right. So the New York Times calculator is saying, well, it's better if I buy this place if I can get it for under, 4,200. But what you're telling me is the actual cash out every month in order to buy the place is 8,400, and yet I can rent it for 5,000. Why wouldn't I just continue to rent for 5,000 then?
Right.
Well, what's your answer to that?
I mean, listen, you're building credit, you're building equity in the property. It's a great investment. This is like a great starter where you do live there for like 4 or 5, 6 years, and then you can rent it out, and then you can always pull the equity back out, refinance, and buy something else. That's what all the big investors do. They stress on Instagram and TikTok how I have all these properties, and every 4 or 5, 6 years I'm going in there, I'm pulling equity out and buying something else. So
let's say that you own this apartment for 10 years. What's the chance of you selling it for less than you bought it for?
No, I mean, historically that wouldn't happen.
All right, so let's be clear about this. Historically, that does not happen. We can't predict the future, and I'm not guaranteeing anything. All I'm saying is the data going back to 1976
Correct.
says that if you hold an apartment for 10 years in this town, I don't know about elsewhere, but in this town, you always make money.
Right.
Now that's the market, right? Price per square foot goes up over time in 10 years. You could buy a disastrous bad investment, a particular apartment might not work out, but the market typically goes up over 10 years. So the first thing is when you buy an apartment and you pay mortgage and you build equity, and 10 years later, or whatever your investment horizon is, as long as it's not 1 or 2 years, right? Like 5 to 10 years later, you sell it. You've probably made money on that asset, right?
Absolutely.
If you rent for 5 or 10 years, at the end of it, you don't have anything.
Nothing.
You've got a goose egg.
Yeah.
And in fact, it's worse than that because you paid money, you got nothing back. There's a zero return on all that money that you gave to the landlord. It's great for the landlord. You really did build your landlord's equity because their asset is worth more.
Why not you be the landlord? Why not you be that person who is building as generational wealth and like building a portfolio and buying and then taking equity out and moving up in class? I mean, why not? Everyone's trying to do it.
100%. Okay, let's but if I say to you, listen, Johnny, 8,400 is more than I want to choke down. Like I just can't do 8,400.
Right.
What are our options here?
Well, listen, you'd be surprised how many of my customers love our 7-year or 10-year ARM interest only. And real quick, to explain it, is that ARM is adjustable rate mortgage. So we offer a 5, 7, or 10, which means that let's say people say I want to do a 10-year ARM, the rate's fixed for 10 years. After the 10th year, the rate can adjust. But going back to our earlier conversation, statistically, people will do something in 70 years. So I do kind of stress, I think it's safer to do a 10-year ARM as opposed to 7-year ARM. Now, the interest only means that it gives flexibility to the customer to make just the interest only payments, which would cheapen your monthly payment from, let's say, $8,400 to down to about $6,400. So that frees up $2,000 for you. If you could pay it down, you could pay the mortgage down, the principal balance, and the payment resets automatically every month, which is a great feature. So then your monthly payment drops, or you could take that money, maybe invest it somewhere else into the stock market or wherever you want. A lot of people that work in the city, I'm not saying everybody, but some people they get paid heavy bonus or they get RSUs, stocks and so forth, and or like commissions. So like to have the flexibility of being able to pay extra principal at their leisure.
Yeah, so this is there's a lot of Wall Street people in this town, and they're very bonus driven, right?
Right.
And so they're characterized by relatively low base. Let's not cry tears for them over that because the bonuses are big. So what they don't want is high monthly costs.
Right.
But if they buy a $3 million apartment, they want to keep those monthlies low. But in 5 years, they're going to probably pay it all off for cash because they're going to get a big bonus and just like wipe out their mortgage and be done with it. So for them, having an interest-only mortgage, which keeps their monthlies down, makes sense, right?
Absolutely. And then typically, at least in the last, obviously years ago it was lower, but the rate even today is going to be about from a 30-year fixed, almost maybe like 3/8 to a half lower in the rate. So that's another advantage of the customer.
So let's talk about that. There's two things that impact that price. For this apartment, we said it was about $2,000 less per month, right?
Mhm. Yep.
So part of that is the rate is better. How much better is the rate?
It's about 3/8, almost a half. So on a 30-year jumbo, 4.5. On a 10-year, you bet 4.125. On a 7-year, 4%. And then going back to maybe potentially moving assets over, you could be down to like in the high threes.
Okay, so we could get our interest rate down to the high threes, but the second component of keeping this monthly cost down is that you're only paying interest, right? So you're not actually paying down the principal of the loan at all. The
Correct.
principal of the loan stays the same the entire 10 years or 7 years or however long your IO. And so it's between those two components that keep that monthly rate much, much lower, correct?
Correct. Yes.
Yeah, and so let's sort of like talk about a punchline here. I think it's obvious that if you want to buy the same place that you're thinking about renting, you're going to pay more out of pocket, right? I mean, that's true. On the other hand, from an economic perspective, building wealth for your life and your future, you're far better off buying in this market, right? Because rents are as high as they are. You're just far better off buying. The question really comes down to, can you afford it? And that's the issue, right? Affordability. So if you can afford it, there's hands down better off to buy. And I'm buy right now.
Yeah. And earlier is like, to your point, if you can afford it, is that like, obviously I mentioned the rates have dropped a little bit, but I always stress the monthly payment. Like, let's speak about the rate for a second. I know rate's important. You're at the cocktail party, you're like, well, I got 3, and I got 3.25, whatever it is. But focus on the monthly payment. That's the most important piece.
Yeah.
So, I mean, everyone's coming out with like, a monthly payment and date the rate and all this kind of stuff. But the most important thing is like, be comfortable with the monthly payment. That's what's going to be every month. The rate, you can always refinance in 4 or 5, 6 years if the rates come back down. So,
all right. Well, let's take a look at what buyers need to do if they decide that they want to buy something. So I think people have questions about that. So first of all, you probably should have a buyer's agent, and you should almost definitely have a mortgage person on your side.
Yes.
And mortgage people and real estate agents work hand in glove together as a team to make this transaction happen for people, right?
Yes. Yeah. I'll just chime in, Mark, about a pre-qual and pre-approval, if you don't mind. So yeah. I do think it's important once you connect with your real estate broker, obviously you get connected with the mortgage banker, aka loan officer. There's either pre-qual or pre-approval. I think there's a misconception that, I don't want to get pre-approved. I don't want to run my credit. But even if you get pre-qual, you're still running your credit. The difference is no one's going to take you serious with the pre-qual. The listing agent, the homeowner, the buyer's agent, because pre-qual means you haven't submitted any paperwork and maybe you're not that motivated or serious. Now, fast forward to getting a pre-approval means that, yes, we did a hard pull. We've actually collected W-2s, pay stubs, bank statements, showing proof that you can afford the monthly payment. And this way you present that to the listing agent or the broker, they'll take you that much more serious. It's also important that when you get pre-approved, it's good for 120 days. So, you don't have to rerun the credit. If you're out there looking, let's say you get pre-approved for $1 million condo and you say, hey, John, you know what? I saw something this weekend for $1.05 million. Do I have to come back and rerun again? No, we'll just, update the numbers and make sure the ratios are fine. But there's no reason to rerun your credit again.
So how long does it take to get pre-approved and what sort of documents do they need to give you?
Good question. So as long as the buyers are motivated, if they apply online, which typically every bank does that now, and then they submit, if your W-2 wage earner, will collect always 2 years, right? It's like 2, 2, 2, 2. So 2 months bank statements, 2 recent pay stubs, and 2 years W-2s for 2020 and 2021 if you're a W-2 wage earner. Now, if you're self-employed, you get heavily commissioned, then underwriting is typically going to want to see tax returns, which means then we'll have to get 2020, 2021 if you're self-employed, personal and business, because sometimes you're self-employed, you're taking deductions. You say, I make $500,000 this year, but they don't realize they're writing off the car, the travel expenses, gas, food. They're driving that 500 down to like 250. That's why it's important, especially when you are a buyer. and you're like, oh, I don't want to get pre-approved, and all of a sudden they find that you're self-employed. They want to make sure that you qualified to make the mortgage payment.
Makes sense. And I will say from the real estate agent's perspective, if we're working with a new buyer, question number one is going to be, well, what's your budget, and like, well, where do you want to live, and all that, the basic questions about what they're looking for. And then it's going to be, are you paying cash or are you financing this purchase? And if the answer is we're financing, then I'm going to say, have you been pre-approved yet?
Right.
And it's almost going to be like one of the very first steps in the process, because heaven forfend, they find a place very early on in the search that they want. They want to put a bid in. They say it's financed. The very second question from the seller's agent, besides price, is going to be like, well, they're financing. Have they been pre-approved?
Right. and more than ever, Mark, I can't tell you how many listing agents are calling me up. Hey, can you call me back if you don't mind? I'm calling on this pre-approval. So more than ever, they're covering their sellers' tracks and so forth to make sure that the buyers are qualified. Also, one more important thing is that there's also a misconception that buyers say, I don't want to run my credit. Is this a hard pull? So I explained to them, listen, top tier credit is typically 740 or above. So as long as your credit's good, number one, you have nothing to worry about. When you're applying for a mortgage, you're trying to get the best rate, it's perfectly okay to run your credit 2-3 times during a 2-week span. The creditors know that you're applying for a mortgage. They can tell. Now, if you're going to get a credit card or a car or a boat, then your score will drop because it looks like you're trying to obtain a lot of different debt. So it's very important to know that it's perfectly normal and acceptable to run your credit a couple of times when applying for a mortgage.
Okay, that's good to know. All right, so then back to the buying process. We're gonna say, hey, go get pre-approved, and then we're gonna start looking for properties. When we find one, there's a negotiation process that happens, and we are gonna submit an offer. With that offer is the pre-approval. It's a necessary document to submit a bid. And if we find an apartment and we don't have the pre-approval, then we could lose the apartment. If it's a competitive bidding situation and other people come in and all of their documents are tidy and they submit a bid while we're scrambling to get our pre-approval because we didn't do that early enough, then it's a competitive market. We might miss that apartment, so that's not good. You're going to want an attorney in this process. And it's like the real estate agent, the attorney, the mortgage professional all work together. So the attorney will do due diligence and recommend whether or not you can sign the contract. When you sign the contract, it kicks off a new process, which is contract to close process. Two things there. There's either a condo application or a co-op application. Co-op applications are quite complicated and do require a professional on your side. But also you have to immediately submit that loan application. How long do you have after the contract is signed to submit your loan application?
Well, typically, like when someone does a pre-approval for us, that pretty much counts as an application. They've actually ran the credit, applied. So back to your point, when we get a fully executed contract, we actually turn the application live right away. Also with that, Mark, as I mentioned before, I think it's also important to know that when you're applying with Citizens Bank that if you're out there looking to get pre-approved, we can lock you in. There's no charge to get pre-approved as well. And there's no cost to locking in a rate. People should know that, okay? The only charge that most banks will take is once you sign contracts, they'll take the appraisal fee. So
Got it. Okay, well then you sign a contract, you complete your loan application. Sounds like with Citizens, it's very fast and easy because they will have front loaded a lot of of the loan application. And then, to the extent that you're in a co-op, you have a board interview and then you schedule a closing, and then you own the property. And that's really the process. I mean, I've glossed that process a lot because that's not really what we're aiming at in this particular seminar. We can do another one where we get into closing costs and co-op versus condo and all of the various things. But today, what we really wanted to focus on is like, does it make sense to purchase or rent, and under what conditions? So let's finish with one last consideration of this. Is there a condition under which you would suggest renting as opposed to buying, John?
Would I recommend renting? No, unless, right now you're not liquid and you don't really have any assets. Maybe
yeah. So can we just do side by side while we're talking here? Thanks, Charles. So first one is you can't really afford it, right? Nobody wants to be house poor. But it's way more uncomfortable when you're scrambling to pay your mortgage. It's like it ruins your credit if you don't pay it and stuff like that. Landlords, maybe you can negotiate like, oh, can I get you next month? And they're like, sure. Well, the banks are not nearly as nice about that. So that's point number one. Point number two is if you're planning to only be in New York City for a couple years, and you are gonna sell or like you don't want to retain an investment property, then you should rent. You should rent because the buying and selling costs are extremely high in this town, right? Selling is over 8% closing costs. You have to pay a real estate agent 6%. Your transfer taxes are like 2%. That's 8% right there. And so like it adds up really fast. So unless you're holding on to it for the medium to long term.
No, that's a good point. And typically also, Mark, don't forget, like, going back to co-ops, which is probably like 65% of Manhattan, maybe more probably. Closing costs are a lot cheaper, which is one benefit to a home buyer. So I think that's one thing that people should focus on with regards to closing costs, especially on the purchase side.
Yeah. So for closing costs for a co-op, let's talk about that. So for starters, there is no mortgage recording tax, right? How much is a mortgage recording tax?
1.85%.
Yeah, it's
almost 2% of your loan.
Almost 2%.
Almost.
It's crazy, right? Like the reason you're borrowing the money is because you don't have it, right. And because you don't have it, you have to pay a tax. So it's a real kick in the teeth. But for a co-op, there is no mortgage recording tax. Why is that?
Well, technically, you don't own the co-op; you have more of like a share. So you get
like it's not actually a mortgage, right? It's a kind of loan for shares, and so for whatever reason, the government does not tax you like you were buying real property. Okay, that's great. And the other thing is title insurance is expensive, isn't it?
Correct. Title insurance could be at least 1% sometimes of the price, depending on more. So that's a big, so on a co-op, typically, if let's just say it's below $1 million, closing costs could be maybe $3,700 for a co-op. That's it. Which includes the bank attorney fee, the appraisal. You have what they call UCC1 and a lien search. That's all it is. It's about $3,700. So very affordable on the co-op side.
On a condo, I mean, it could be $10,000-$20,000 without batting an eye.
Yeah, so, and I also want to bring up too is also that more than ever is that on a co-op and condo, don't forget, gifts are allowed, and I've never seen more gifts than in the last 5 to 6 years from parents, from family, or whatever it is. Gift is always allowed. If my dad's giving me a gift for $50,000, he writes me a check for $50,000. I deposit my account. I show underwriting that it's in my account. It comes out. That's it. I don't need to show underwriting where it came from. We just get a gift letter. And that's it. So it's very simple. It's not so intrusive, if you will, of family members. Or why I have to show them my bank account. So as long as it comes from them into your account, we can document it. That's all it is. But gifts are very common these days, and it's allowed.
I mean, with the average price in Manhattan over $1 million, it's almost shocking that anybody can buy their first apartment without a gift.
Right. Yeah. And that's why it's very expensive, as we know. So that's why we like to encourage, especially first-time buyers. Listen. Go get a gift, I mean, everyone's looking at, especially family. So,
yeah. Charles, have we got any questions coming in on the chats? No, I don't think so.
They'll come in hot. Don't worry.
All right. So I think we're done. Is there anything else you want to cover today, John?
No, I think maybe it's just Charles had some of the don'ts.
Don'ts. Tell these people what to do and what not to do, because I think you do not want to screw this up in the 11th hour.
So some of the do's, like obviously make your rent payments, because typically, especially as a first-time home buyer, Listen, a lot of times first-time home buyers don't have like 3 or 4 trade lines. So every bank wants to see that you have maybe a car payment, a credit card, a student loan. And someone's like, well, all I have is my rental and a credit card. All right, well, we can get 12 months of rental history. So make sure you pay your rent on time, pay your credit cards on time. Stay at your current employer. Quick thing about do's and don'ts on your job. If you're a W-2 wage earner and you're moving during the mortgage process, which is still a pain, as long as you're going to another W-2 wage earner, it's fine. It's only when you go from saying I'm a W-2 wage earner and now I'm going to start my own business, that's a problem. Do not do that, because Mark, is that once you go self-employed, underwriting doesn't know how much you're going to deduct. They don't know about the business. They don't know anything. So they won't lend, especially if you go from W-2 to self-employed. Again, don't change jobs during the mortgage process. Don't apply for any credit cards. With your credit card balances, very important. I see on the FICO scores, Mark, is that always try and keep your allowable usage below like 20% on the credit card. Very important. Don't make any large deposits, right? Any large deposit go a certain amount of your income. They're going to want to document where it came from, and that's more of a headache for you. Don't take out any new car payments.
Well, hold on. I have a story about that one. So I had somebody in my office. This woman was Morgan Stanley. She was highly qualified. She went out and bought a car in between the accepted offer and the closing of the loan, and the car was financed, and the financing on the car was $1,000 a month. It was a nice car. Yeah. These days, $1,000 a month probably gets you a Honda Civic because it's insane. But like back then, it was I think a 5 Series Beamer or something. Right. And guess what? She got denied for the loan because it changed her debt to income ratios significantly. You know.
Yeah, so and people they want to transfer. I'm going to transfer all my credit to a new credit card, but then you just lost all that old credit you have in the credit card. So during the mortgage process, don't transfer credit card balances. Just kind of behave for 45, 60 days. Because as we discussed, Mark, especially on a condo, closing's about 30, 45 days. On a co-op closing, you're looking at probably, like you said, 60 to 90 days because of the board process, interview process, and so forth.
Yeah. I mean, just don't do anything rash. You're okay to pay down debt in this period, but don't take anything new on, and don't buy anything of any significant nature, especially if it's financed. Just don't do it. Just behave like an adult for 45 days. That's all we're asking. Okay, so I think we're good to see if there's any Q&A. I have no idea whether there is or not, but here we go. Davi Santos says, what if you have an S Corp? Is your income that of your business because it's different from the money you pay yourself? Explain that.
They're still going to look at the S Corp, personal and business, to see if it's passing through. Because some people say, well, my personal returns show this much, but they're still going to look at the business. Even if you're a Schedule C, they're going to look and see what the Schedule C is too. So it's very important when you're going for a mortgage, Davi, and you're applying for a mortgage. Let's just say there'll be a certain point where you're about to do tax returns, and I'll be like, hey, listen, before you file, send me your draft returns. Let me have underwriting look at it to see how much you qualify for, because underwriting is always going to use 2 years of tax returns for self-employed people. Very important.
That's a good question. And so what's the situation though? Can you dig into that where, let's say you have 100% owned S Corp, you pay yourself a low salary and you keep retained earnings in the S Corp. Do you get to count those earnings in the S Corp?
So you're paying yourself a W-2. We can use the W-2 salary.
Yep.
Whatever it's been for the last 2 years.
But what about the retained earnings in the S Corp if it's 100% owned?
Case by case, typically. I mean, it's hard to comment on that. I don't want
Well, send it to underwriting and see how they deal with it.
Sometimes. But don't forget, we can also exclude car payments if they're paid by the business. Any other big debt. Sometimes people have boat payments that are paid by the business. We can exclude those.
Yeah. Okay. And do we have any other questions from our audience here? We're absolutely happy to do it. All right. So how do people get in touch with you, Johnny?
My cell phone is 410-4583. I think Charles is going to put my contact on that, but my email is johnny.v, johnny.v @citizensbank.com.
So I'm just tapping in. It's coming through as Josh putting that up, but that's Johnny's cell phone right there, and what I'm putting it into the chat.
Thank you.
Oh, wait a minute. We have another question from Steven, who says, I was told not to make any large transfers. I'm paying cash. So why can't I transfer money from one account to another?
If you're paying all cash for is it a condo or co-op, I think is maybe one thing. If it's a condo, I don't think it should be a concern if you're paying all cash. It wouldn't involve me on the mortgage side. If it's a co-op, Stephen, I would definitely ask your broker, but sometimes the boards will want to see like the most recent 2-3 bank statements. And if they see a large transfer, maybe they could raise a red flag. Where did that transfer come from? Now, if you could document it, if it came from your Merrill Lynch account into your Chase or Citizens account, then I don't see why it would be a big deal, as long as you can document it.
So I will answer you, Stephen, on this, because we have some experience with co-op boards. The real reason is not that you'll ultimately be turned down. It's that it's going to generate a whole new set of questions, and those sets of questions might engender the documents that you have had submitted for the board package becoming outdated. So let's say you submit a board package and then you do something, and they discover that you've done something like transferring money from one to another. Then they ask you questions. The process of reviewing and sending you the questions and you getting back to them, we might get into the next month. And then they say, okay, well, I'm glad we know the answer to that, but now your account statements are 60 days old. So please resubmit your board package. And so that is probably what your broker is trying to avoid, is that timing process just taking forever, where they continue to ask questions and then ask you to resubmit your whole board package already. If they already have them, the statements, then I don't know why that is that they're saying not to do that. But my answer is so that they don't engender a bunch more questions that require back and forth and back and forth.
And sometimes boards can just be more difficult than the next board. I mean, I know he's probably frustrated, but sometimes just how it is sometimes, unfortunately.
Yeah, Charles. Stephen, I would do that. Just, I mean, if you can, unless it's causing you great financial pain to not do whatever transfer you're doing, I would just sit on it and hold off until you're approved. Once you're approved by the board, you can do it even before you close. Yeah. Charles, can you put my contact information into the stream and Johnny's into the stream so people can see where to get us? I suppose there's a lot more detail we can go into. Buyers often don't realize how tricky this process is, especially in Manhattan and New York City in general. I don't mean just Manhattan, but New York City is a really special beast in terms of its complexity. So if anybody wants to reach us and ask any questions, I'll just say it verbally. I am Mark, M-A-R-K, @RubinTeam.com. That's Mark @RubinTeam.com. My cell phone is 646-491-1691. And Charles has posted up my office line there, and Johnny's is about to get put up as well. So I thank you guys for attending. I really appreciate you taking the time to listen to us talk. I hope you found it useful. This is going to be the first of a series of in-depth topics the Rubin team's doing. And I encourage you to just continue to come onto these streams. There's Johnny's information. How do you pronounce your last name again?
Vlogianitis. That's why we call him Johnny V.
Vlogianitis. This is why everybody calls him Johnny V.
And if anybody cares, I was at Washington General. I played against the Harlem Globetrotters for like 2 years.
Wow, that's cool. Yeah.
Yes, we lost every night, and it's fixed. Okay.
Nice. All right. Well, thank you, everybody. I appreciate your joining us for this stream. And if you want to go back and review, this will be on YouTube forever. And if you have in-depth questions, do not hesitate to reach out and contact me directly, or contact Johnny if you need mortgage help.
Thank
Take
you.
care, everybody.